Good morning. Welcome back to the Broadcast Retirement Network. This is BRN Weekly for Saturday, August 24th, 2024. And our top story today, the stock market is more top-heavy than before the dot-com bust. Joining me now to help break it all down, Jane King joins us from the NASDAQ. Jane, so great to see you again. Thanks so much for joining us on the program this morning.
Good to be back, Jeffrey.
All right, let's talk about, I want to say portfolio concentration, but let's talk about index concentration of the S&P 500. Highly concentrated towards tech stocks, even more so than during the dot-com era. Your reaction to that, is it overstated or is it understated?
No, I think it's really important. There's like 7 stocks basically that have led the market to record highs. And we've had it, we had a pretty significant correction a couple weeks ago, and, and then we've kind of slowed down a little bit since then. But, it's NVIDIA, of course, and Facebook and Apple and Microsoft, and who am I forgetting? Google. There's 7 stocks.
Don't forget Google. They're
that
listening. They're listening, by the way.
I'm sure they are. Yeah. And Amazon is too. And they may be one of the 7 also. So, yeah, they've been leading things higher. So the question is, is that really a good indication of the economy? If you've got just 7 very highly concentrated $3 to $4 trillion companies that are leading things, but everything else is kind of just stagnant, it's really not a broad-based recovery in the economy. And that might be one of the reasons it explains why the market and why people still feel kind of like the economy is not as good as some of the headlines are reporting.
Yeah, are you seeing in the numbers that what reflects in the jitteriness, if that's even a word, of people, retail investors, but also institutional investors? And I've seen, the market came back over the last couple of weeks from that, the last time we chatted with you, there was a significant downturn, I think, over the course of a week. It didn't look good. Then it bounced back, and volatility seems to be the norm these days. But is that jitteriness, there?
Yeah, well, there's like a lot of cross currents. So we've got, some like the markets are doing pretty well. We do get
Yeah.
earnings from NVIDIA next week. So that's going to be interesting, whether this, that continues another leg higher, or maybe, that's overblown. But, some of the other things are, we've got, dissatisfaction in the job market. And we've got credit card debt is at a record high. And, and the housing market, people can't afford homes. And so there's all these like cross currents that are going on right now. And I think it just depends on which indicator you look at. But I just get the feeling like Main Street is just kind of meh about the economy. I'm not real excited about it. They don't feel great about it. But if they've got a 401k, that's probably doing all right.
Yeah, and because a 401k is probably invested in mutual funds or index funds that are heavily concentrated in those 7 stocks you mentioned at the,
right.
at
Yeah.
the
If you're in
outset.
the S&P 500 or something like that, your 401k is doing well.
Yeah. So just going back to the top of the top storyline, is this analogous to the dot-com era? And you and I both lived through the dot-com era, showing our age a little bit, but we lived through the dot-com era in all seriousness, and that was, valuations that didn't make sense. There was no profitability. I'm being very generic here, and then boom, things kind of collapsed. Is that the same? Is it analogous to what we're experiencing today with these top 7 companies?
I think it's different in the fact that these 7 companies actually have profits. And you think back to .com era, it was socks.com and pets.com. Companies that were making no money and couldn't really explain, and there was kind of this felt like it was this kind of nothing underneath them. Whereas with an NVIDIA, it feels like, yeah, maybe it's gotten ahead of itself, but it got a great business there. And it's, in the cutting edge of perhaps an AI revolution. So is Google, and so is Microsoft, and so is Facebook is in AI, and Apple's trying to get there as well. So I think it feels more solid than the .com did to me. But it doesn't mean we can't have a correction and it hasn't gotten ahead of itself.
And Jane, what about American manufacturing? What about financial sector? What about the banks? What about healthcare? They're lagging, but they are, Jane, going to use artificial intelligence. I read it every morning, and when I put the newsletter together, uh, AI can help reduce healthcare costs. AI can help with the supply chain, right? So are these sectors going to start to pop up a little bit in terms of profitability? Maybe take some of the pressure off these top seven.
Well, and you'd think like that they would see increasing efficiencies from the use of artificial intelligence, which should help with the bottom line. Another thing impacting the banks, so you mentioned interest rates. We're probably going to see the Federal Reserve cut interest rates in September. In fact, the big debate on Wall Street now is not if they'll cut, but how big will the cut be? Will it be a 1/4%? Will it be a 0.5%? So that should impact a lot of different industries. Housing, could impact, the banks as well. So there's a lot of other things that we're kind of keeping an eye on. Interesting to see that the Bureau of Labor Statistics overestimated jobs created in the past year by more than
How do you
800,000.
do that? I mean, I'm going to call out the BLS. How do you do that?
Well, what's interesting was that for month after month there for a while, we would be like, okay, economists expect 200,000 jobs added, and it'd come in 350,000. We're like, what? How did they miss this by this much? So, and then they'd revise things down the next month or two. It just seemed like they weren't. And I guess, they measure this through employers, but then there's also the household survey that measures jobs, and they actually talk to households and go, who's employed in your household? And that was actually more accurate take on the job market over the past year than what the government was doing when they were talking to employers. So yeah, that was kind of embarrassing. And the
Really
markets
embarrassing.
move on these numbers, and people lose and make money on these numbers. So they've got to figure out a way to be more accurate.
Yeah, I mean, in today's age, when we have artificial intelligence, Jane, and we have all this technology, you should be able to do almost an instant polling of employers or of households. It really shouldn't. Jane, last question. We're approaching Labor Day. In fact, the next time we will talk to you is after the Labor Day holiday. What are you looking for? Labor Day, obviously a big day of people coming back from the office. But what are you looking at in terms of data, in terms of the economy, in terms of stock market?
Well, of course, the Fed meeting, that will be in mid-September, but then I think we really start to get into elections and, how is that going? We've got a debate on September 10th. Will that offer some clarity to what at the moment looks like a very close race for president as well as for the House and the Senate? So I think there's going to be a lot of calculations from the big banks and the analyst firms about what are the percentages of a Trump presidency and a divided Congress and Harris and and so I think we're going to be really evaluating economic proposals and what they mean for the markets and for the overall economy over the next few months.
Suffice to say, Jane, I think there's going to be enough news for the news outlets to cover. We'll try to be very thoughtful in our approach to looking at this. Jane, we always appreciate having you on the network. Thanks so much for joining us, and we look forward to talking with you after the Labor Day holiday. And when we come back, we take a look at some of our best segments for the week. You're going to want to stay tuned right here. BRN Weekly. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device. Welcome back. It was another great week of programs with great topics and, of course, great guests. We kicked off the week with a look at balancing caregiving and work responsibilities. It's a challenge. Let's take a look.
No, because I've been in this field for a very long time and know that there are about 48 million family caregivers, and they're caring for family members, neighbors, friends. It's not always even a relative. And I've known all along that over 60% of them work on top of what they're doing. So juggling is always a problem. The COVID epidemic, in a sense, had a silver lining that some people could work hybrid. Not everybody could work, and be with, the person they're taking care of. But it's really hard to do 20 hours of caregiving on top of your job, which is the average, 20 hours. Exactly, because many family caregivers start to feel that they have to cut down on their hours working because they have so many hours providing care. And that affects, of course, their income, not just for themselves, but for their families. And it has like a generational flow to it, that it affects your social security, affects a lot of things down the road. So, and they also worry that somebody is going to look not so kindly on them, their employer, that they will think, well, they're not really paying attention, or why are they leaving early to go take, as it turns out, their mother or father or brother or somebody to the doctor's office or something. So they keep it inside. And that's stress when you're
Yeah,
keeping
that
things inside. We're seeing more of it. Again, I think COVID really shined a light on the fact that lots of people were family caregivers and they needed that kind of flexibility. So flexibility is the number one thing. If you can offer somebody the ability to work at the different hours and the different places they can work, of course, not every area can do that. I'm a nurse by background, so you can't just work hybrid all the time as a nurse, but at flexibility and understanding that you have a lot of people who are working for you as an employer who are doing these things. And by the way, they themselves might be doing it. So, they're not immune to being a family caregiver themselves. So being very open to that, sharing the fact that they either are a caregiver themselves or they know others that are, and we understand that this is an economic problem for employers. If they can't retain their workforce, that's a serious problem, trying to replace them. Retention is everything. These family caregivers, I mean, they're talented people. They want them to work. They want to do a good job. So the employer needs to do everything they can. Paid family leave, even if it isn't a state or federal benefit, give them that time off that they need to have. That's the other really big important part. And one of the things the study that we did with S&P Global showed was that even when the employer is offering benefits, very often the family caregivers aren't aware of the benefits. So it's not just creating them, it's letting people know that they exist and letting them know it's okay to use them. Please use them. Like, again, people worry that if they use the benefits, they will be passed over for a promotion or some negative thing will happen to them, all that anxiety. So an employer that says we have benefits, here's where they are, and please use them as you need them because we want to retain you.
Next up, we discussed the time is now for retirement income solutions. Let's take a look.
Adoption is definitely picking up, but I think that's going to accelerate dramatically as record keepers come online with their programs. There was a large record keeper that made a significant announcement a couple of weeks back, and I think that there's going to be others that will follow. So you can use the comparison. You could go to the store, the product that you may want is not on the shelf. I think that's where we kind of have been with retirement income. There's a lot of good solutions out there, good product out there, but they haven't yet become available on the record keeper's shelf. So that's starting to happen. And I think as that accelerates and as we get to industry norm adoption level, it's going to make it even easier for people to get access. And that's where I think, to your question, the adoption is really going to pick up and accelerate. Yes. So I think that advisors, consultants are an important part. They're a catalyst for adoption at the plan level for sure. So as they get more comfortable, educated on these solutions, how they work, what fits the needs of the various plan sponsors, that's going to help move it along. And I think to your first question, I think as record keepers are setting up their programs, they're leveraging technology providers to enable kind of a one-to-many connection, so they don't have to connect individually to all of the different products out there. And there's a number of them, and I think that's important because particularly for the larger record keepers, they're going to have different needs from different plans, and even within a large plan, the need of a 22-year-old that's just coming into the firm versus somebody that's approaching retirement, their needs are very, very different, right? And the types of solutions they're going to need is very different. So there's not going to be a single solution that's going to meet the needs of everybody. much like there's not a single fund, you have more than one fund on a menu, you're going to need to have multiple solutions available. And maybe a plan isn't going to adopt every single one, but they at least need to be able to have choice to pick the products that best suit the needs of their individual participants. Yes, great point. I think about 2/3 of the assets, according to recent Cerulli data, come into plans via QDIA, right? And into target date funds via the QDIA. And I think for us as an industry to think that retirement income adoption flows are going to be different than how traditional flows come in is just not the correct approach. So these solutions have to be defaulted in some form or fashion. So obviously the QDIA would be the biggest, but there's other ways that you could get default-like access into these solutions. There could be a paternalistic plan that wants to put an employer match, profit sharing, and they feel it's in the best interest of their participants to get access to these products through those programs. And then through managed accounts as well. And I think that's where the personalization comes in, the ability to pull in outside assets, pension, account for Social Security as well, and really provide that holistic retirement plan as opposed to just a kind of a single focused age retirement based target date type of solution. So I think that we're definitely moving in that direction. And again, technology, being able to analyze data, pull data in, that's important, a really important factor to enabling all of that. Yes, so traditionally it had been a large issue. So most of the products came out, they were proprietary, so they really couldn't be moved. They were, when I say proprietary, it was a record keeper that traditionally had an asset manager and an insurer, and they created these products and they made them available within their record keeping platforms. Now we have more third-party products coming to market, non-proprietary, so it's not just the record keeper. There's other players in the industry, asset managers, insurers, and even consortiums coming together to bring these products to market. So Secure 1.0 really addressed participant portability. So it's now required to provide portability if you're leaving the plan out to a participant to maintain those benefit values. That's law, that's a requirement. I think the other, and technology is enabling a more seamless flow for the participant to get from point A to point B, maintain those benefits, and continue to get access to the product they initially bought into. On the plan side, back to the proprietary, there is a concern, even if I bought into one of these solutions, I would then get locked in with that record keeper and forever. And if I tried to leave, then it would be really messy for my participants to maintain those benefits, right? So now utilizing technology and those one-to-many connections I spoke to before, you have a single entity that's sitting on those guaranteed benefit values. And as that plan chooses to move from record keeper A to record keeper B, they're simply porting those benefits over, and the product has to be available as well in both of those situations. But allowing that ability to port those benefits over, maintain the product in the same way that it had occurred on record keeper A onto record keeper B, which is really important. And that's helping a lot of advisors and consultants get over that hurdle because they knew about these first generation products and they didn't want to get their clients locked into a single relationship. It's not in their best interest.
That wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to? Drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, then visit our website. We're back again tomorrow morning for BRN Sunday. We'll be breaking down what's going on Capitol Hill when it comes to retirement legislation, litigation, arbitration, mediation, and so much more. And then we'll take a look at the economy and the stock market. How's it doing? Well, you're going to want to stay tuned. So until then, I'm Jeff Snyder. Stay safe, keep on saving. And don't forget, roll with the changes.